In market news now, poultry producer Astral Foods reported the first loss in its 23-year history as power outages and the worst outbreak of highly pathogenic avian influenza increased costs. The company, which owns brands including Country Fair and Goldie Chicken, said total costs associated with the disease outbreak and the electricity crisis amounted to more than 2 billion rand. Meanwhile, private hospital operator Netcare has identified a preferred candidate that it wants as CEO to replace Richard Friedland, but the candidate is unavailable for an extended period. So Friedland has agreed to remain at the helm beyond September 2024 for another 6 months. In July, Friedland announced that he would be stepping down after almost 2 decades to retire early. However, to give us some perspective, shifting gears a little bit and looking at the fixed income markets, we are joined by James Turp, who's a portfolio manager at Sanlam Investments. James, thank you so much for your time. Let's get into your assessment right now when you look at the bull and bear case for bonds.
Thanks very much for having me, Nastasha. Well, bonds have had a fantastic month so far. It's been a difficult year for bonds, if we're honest, but November so far has been great, starting off with a medium-term budget, which was slightly worse than from a debt point of view, but the real positive has been the global picture. For interest rate hikes, it seems like the world's got inflation, at least the US, under control, and it seems, in their words, to be the end of the hiking cycle more than likely. So that's really got our bonds capturing a really good month, around 4% up so far in November.
So let's talk about these Fed cuts that everyone seems to be pricing in going into next year. When you look at that conversation around Fed cuts, do you think they'll come as a result of a recession, or do they come as a result of inflation?
That's a really good question. The coin's actually in the air on that one. So they talk about this soft landing, which is getting inflation back to the target whilst avoiding a recession. Now, so far, we've seen the cooling off in the employment data, which they deem the sort of important data to look at for the state of the economy, is cooling down. It's not crashing at this point. And we're also seeing inflation, last week's numbers coming in below expectations. So they're moving gradually. And if that picture remains the same, then they'll get that soft landing that they so desire. And then it'll just be this sort of Goldilocks scenario of getting inflation back and getting interest rates down. And that will lead to, one would hope, positive asset market performance. However, there's the other point of view, and that is that what they're not factoring in is these other indicators that have been cooling more quickly and crashing, and that could suddenly lead to a recession. It's not really the base case at this point of view. Somewhere between the soft landing and perhaps even no landing is some views as well. So for now, it does seem like a pretty positive outlook.
When you look at financial conditions right now, are you concerned about what's happening on the short end of the curve or the long end of the curve?
That's also portfolio specific. So if you look at the bond curve, you're getting around 11% yield to maturity for bonds that expire in around 8 years' time. That's pretty good returns. Of course, those yields have come in over the last month. But then if you go from around sort of 15 years out to 30 years, you're getting an additional 1%. So you're yielding around 12%. So I think, in a risk-adjusted portfolio, you're actually getting that value between 8 and 15 years. So that's where I would position the portfolios. If you're against the bond index, then perhaps you want something a little bit longer, but it's really flat from around 15 years to 30 years. So I still like that belly, that 8 to 15-year area of the curve makes the most sense.
All right, so we've got the Reserve Bank meeting on Thursday announcing the interest rate decision. Your expectations?
No change. I don't think, given this development offshore, I think you'll hear them, they'll talk about concerns, risks to inflation probably will be seen as balanced. They'll mark their inflation forecast down, we would think, in line with what we've seen other analysts do. But I don't think they will be indicating a change to that outlook. I think you'll probably even get a unanimous hold at this meeting. It's very difficult to see them hike at this point. Never say never, though, but we expect no change.
Before I let you go, speaking of concerns, is there a concern that you have right now?
You know, from a South African point of view, one thing to be considered is the elections. Now, that's another situation that will come through next year. There's two potential issues that could have. Policy paralysis as politicians go out on campaign and avoid the difficult issues like we heard in your news about 20 minutes ago with the port situation you'll be covering shortly. Those sort of things require being resolved. We need economic growth to solve the problems in the country, and the election may just slow down those developments. And also from an interest rate point of view, you may find the Reserve Bank not keen to cut interest rates because they know there could be volatility around the election that could affect the currency as well. So that's something that we need to keep in the back of our minds going into next year from a fixed income investment point of view.
James, thank you so much for your time. That is James Terp, who is a fixed income portfolio manager at Sanlam Investments. And as he mentioned, after the break, we'll have a look at that port situation and see how it plays out, particularly into 2024. But looking at the rand situation, 18.41 to the dollar as we await the US FOMC minutes. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.